In this video, I'm going to talk to you about another important takeaway that I'd like to share with you. And we've discussed this in class on occasion, but just to drive this point across, I'd like for you to think about how we treat gains and losses differently in terms of whether we've realized or unrealized those gains or losses. So prior to me discussing this, let's just be clear what realized versus unrealized is. So in very generic terms, when you realize a transaction, that's the actual transaction occurring. All right, the exchange, the easiest way to think about it is the exchange of the assets or the exchange of the service is actually taking place. So that's when you've realized that. And sometimes you have a scenario where you might have unrealized gains of losses, and even though you have that potential for gain or losses, you cannot recognize them. And this, an example of that could be you own some property and the value of that property has increased. Well, you have an unrealized gain with that property. Now, for you to actually reap the benefits and be able to recognize that, then you would have to sell that property. Okay, but before you sell it, you would refer to it as unrealized. And in our world, we have a lot of scenarios where we have to think this way, especially for purposes of accounting, and we have to be aware of where we stand in that respect. So one of the forces that constrains us in accounting is conservatism. And because of conservatism, we end up with this asymmetrical treatment of gains and losses, where it's not going to be the same for gains and losses, okay? So sometimes we will have gains that are unrealized that we cannot recognize, versus the losses, even if they are unrealized, a lot of times we have to recognize them. And that's what I mean by the asymmetrical treatment of these scenarios. Okay, so one example that we've seen in our class, and I want to just share these two examples so that we can tie it into what we've done in our class, but I do really want you to think about it from a bigger picture here. This is something that you will see over and over again in your world in accounting, so keep that in mind. But in our context, where did we see this? If you remember, we talked about contingencies. And more specifically, we talked about contingent liabilities that could result in losses. And there's a whole set of rules for these contingent losses or contingent liabilities. And they deal with different levels of probability of loss. And if you recall, if a contingency is probable, okay, so if there's a high probability that you're going to owe some money in the future and you're going to incur a loss, then under the current accounting system here, we have to recognize that loss. And that's definitely a sign of conservatism when you compare it to the treatment that we do with respect to gains. So if you have a contingent gain, in other words, you have the potential to somehow receive assets in the future that will provide gains to you, and it could be that there's a high probability that this is going to occur, you're still not allowed to recognize those gains until you actually realize them. Okay, and it's like a tongue twister, right? But keep that in mind. In the example I just gave you, you have not realized the loss. Okay, there's still an unrealized loss if it's something that could happen in the future, but nevertheless you still have to recognize it. Whereas here you could get some money and it's highly probable in the future, but it's still unrealized, and it's because it's a gain, we do not recognize it. Another place where we saw this was with the issue of non-monetary exchanges in a non-commercial substance environment. If you recall, with losses, if you have losses on your asset as you exchange it, you always recognize them in the non-commercial substance environment. But for gains, there's some restrictions. You may not be allowed to recognize any amount. And if you recall, that's the scenario where you do not receive cash, or you might be able to recognize part of that gain. And then if there is this other exception, then you can recognize the complete gain. So look at what's going on here. This is a realized transaction. Okay, when you exchange your non-monetary assets, that's a realized transaction. But even then, you're being restricted in terms of how much gains you can recognize. Whereas here, in this scenario, if you have a loss, you're going to recognize it no matter what. So always keep that in mind, that under U.S. GAAP, and because of the constraint of conservatism, you will often see this unequal treatment of gains and losses, especially in the world of unrealized gains and losses. All right, this concludes the video on unrealized gains and losses. I take that back. Realized versus unrealized gains and losses. All right.